Good afternoon, good morning, and good evening to everyone. And thank you for joining us on this smart cash placement and how to improve your return on investment. I'm absolutely delighted to be joined by an esteemed panel here of guests to discuss this topic together. First of all, if I could just give myself a quick introduction. My name is Simon Jones. I'm an independent Treasury consultant. I have been a treasurer in the industry for nearly 3 decades as a corporate treasurer and then a transaction banker with a number of institutions around the world. I'm absolutely delighted to be able to discuss this topic with you, with this esteemed panel today. It's an incredibly important time to be focusing on this topic, particularly as we've seen high inflation and interest rates that have jumped very significantly in the last 18 months. So without further ado, I'd like to introduce the panelists to discuss this with me. And first of all, can I introduce Eric and give a quick introduction of yourself? Thank you.
Thanks, Simon. Eric Stark from PwC in Austria, but I'm part of the Global Corporate Treasury Solutions practice of PwC, which is extremely well connected across the globe. And it's a pleasure to be here on this fundamental and highly relevant treasury topic.
Great. I'm also delighted to be joined by Quentin. If you could introduce yourself, Quentin.
Thank you, Simon. So, Quentin Millet, I'm the VP Accounting and Tax at AGICAP, and I'm also in charge of all corporate treasury topics for the groups. And also, I'm a former auditor at PwC for 9 years.
Great. So what I think is great here is that we've got a couple of consultants, but also somebody who's actually at the forefront of doing this on a daily basis, which I think is incredibly important to make sure that we ground and make this topic very real. We're going to go through a number of questions to the panelists that I'm going to introduce. But also, importantly, we're going to make sure that we have about 5 to 10 minutes at the end of the session for audience questions to come in. So during the talk, if you have a question, please put it into the chat, and then we will review them with the panelists at the end. So without further ado, let's go straight into the first question straight away. So we touched on the point about rising interest rates. So first question, how does rising interest rates impact a company's excess cash management strategy? And why is it more critical now than ever to optimize cash placement? Eric, for you first of all.
Yeah, I think for me it's important to frame the argument in terms of a wider picture, maybe, in terms of cost of carry. So a company funds itself by equity, debt, capital primarily, and the amount you earn on your investments, be it short-term, medium, long-term, is for a non-financial corporate there to minimize loss.
Yep.
If you can get a gain out of it, great. But I think that for me is the essential component here, taking a look at the cost of holding cash and any minimization there. And in terms of rising and interest rates, I think the important thing to keep in mind here is when you look at this cost of carry, it's not so much about interest rates being high or low, but how high is the differential between how I can invest, the short-term rates and the long-term rates. Just to put that out there, because this is basically the curve steepness, and right now we have an inverted curve, so it's it's crazy.
Yeah. And Quentin, you know, what's your thoughts on this?
Yes, so for us at AGICAP, I think first we saw it as a real opportunity to add a kind of extra income stream for the company, of course. And indeed, it totally changed the way we manage our cash. Maybe 2 short examples. 2 years ago, we did invest our cash. We just raised $100 million, but the return was like 0%, 0.1%, you know. But we didn't invest our cash for the return. We invested it to avoid being charged by our banks because we had too much cash on deposit. So it was in the negative rates environment. Sounds crazy right now. Second example, 1 year ago, we had absolutely no short-term investment strategy at all. It was, let's say, idle cash was not really an issue. And now I'm managing my cash excess every single day.
Yeah, good.
With AGICAP, of course.
Yeah. Now, it's crazy that we've come from an environment in Europe that, negative, you were trying to avoid negative rates, for just money sitting on your bank accounts. But, quite clearly the environment's massively changed at this point in time. I think the point you made, Eric, around, minimizing the differential between what you're actually paying for your investors, whether that be lending that you're borrowing to support your business, or equity. Equity is not free capital. Yeah. A lot of people tend to forget that every now and again, but it actually is very expensive capital because shareholders expect a high return for investing in equity. So let's move on to the second question. And what are the common sources of excess cash in the business? So really important to understand that. So first of all, Eric.
Yeah, I think the easy answer is hopefully from positive cash generation out of your core business.
Yeah.
So operational cash, but then naturally, depending on the stage of the life cycle of the company and ownership structures, you can have pre-funded capital from funding, especially in a growth company. You wouldn't schedule equity funding rounds or sessions every week, every month, because transaction costs would kill you. So in that case, you would also probably be investing for a longer period of time, whereas in operational cash, usually you want to put it in the business, get it working, and then the business is generating the return, not the short-term investments.
Yeah. No, important points. And Quentin, what do you see as being the common sources?
Yes, so at AGICAP, indeed we manage both kind of cash, cash coming from our previous fundraising operations, about 120 million over several years. So this is indeed the long-term cash. It is used to deliver our business plan on growth. And also we manage the excess cash from our operations, as we have thousands of clients across Europe and the US.
Yeah. Now, really understanding that cash flow dynamic, to understand that excess cash, very easy to understand the large slugs of money coming into the business, whether that be a long-term debt and a bond or equity that's coming into the business in tranches, as you mentioned, but really understanding the ins and outs of the business, the collections, the payments, when they're paid, and when you can expect to receive. Super important to really give you an accurate picture of your excess cash. So what are the typical challenges companies face, when assessing excess cash availability for placement, and how can they overcome these to really getting to that granular level that I just talked about?
I think as in many things in treasury or finance, it starts with data. On the one hand, quick and processable data. So can you get data, be it from your banks, from ERP systems, your internal data, external data? Do you have access, and do you have instant or at least quick access? I think those are the critical components and still challenging. It's been a huge development there, be it APIs and other topics, opening access to bank data, for example. But I think we still have a way to go. But if you can have access to great data, then you have at least the option to leverage technology to get insights from it quickly, easily, and daily, ideally. Yeah.
And Quentin, what has been some of your challenges? You're in a high growth company, fairly early stage of your I would say financial infrastructure. But how have you been able to align some of those challenges and pull data from various sources?
Yes, so I agree with Eric. This is the main challenge when you have multiple sources of data. So, of course, at AGICAP, we believe that treasury management systems like AGICAP are the right answer because you have great connectivity for your banks, but also all your management and finance tools. Maybe two additional challenges that I met as a corporate treasurer. The first one, when you start really from blank, you have to identify your typical and recurring cash patterns and flows within the company that can be at different timescales. Like weekly, monthly, seasonal, multi-year. And once you know them, you know how to set your main investments terms. For this, of course, you need an initial deep analysis based on your past flows. And I would also insist on the fact that those flows should be categorized. Otherwise, you can't analyze this. So it's important to have this. With AGICAP, you can categorize your flows mostly automatically. And maybe a second challenge, I believe that a corporate treasurer should have a good vision of the group's business plan and also to the probability of events like, for example, a huge investment or an M&A operation. And for this, he needs, I would say, constant communications with the FP&A team on most of the company's management, CFO, CEO, CIO.
Yeah, no, and even down to people actually doing some of those deals, and not just the financial planning, but actually getting to a sense of, is this really going to happen on the date that they said it's going to happen? Because we know these things move, these things change as well. But I can see, even in companies of smaller size, let alone to larger companies, there is multiple pieces of useful data in many different systems. And I think, cash flow forecasting has always been an absolute pain for corporate treasurers. It's been painful to do. Most people have tried to do it on spreadsheets, for the last couple of decades. But, real-time data and real-time connectivity to different systems is actually a lot easier than it used to be in the past. And, these things should now become less painful, much more automated, and to be honest, much more real-time as well. If you're using real-time systems, for all those various different processes behind. So I think that's the opportunity that businesses can grasp nowadays. That perhaps wasn't there a few years ago. That is there now.
Especially for small and medium companies.
Agreed. Yeah, but even a small and medium-sized company, a lot of time people say, "Well, you're just using one accounting system, or it's one system." It's not. You might have an expense system, you might have a payroll system. You're still going to have various different systems, to go forward. Anyway, let's move on quickly to the next one. And how critical is an effective cash flow forecasting model to manage excess cash efficiently? So first to you, Eric. So.
Yeah, I think it all starts with the foundation. So if you're in an airplane, you don't want the pilot flying blind.
Yeah.
Be it systems or looking out the window. So basically cash visibility, it starts there. Do I know where I have my cash? Do I have a clear picture, ideally every day, maybe multiple times a day up to instantaneously at some point? And then once again, the data comes into play. And if you have a sound foundation and do analysis to forecast realistically, maybe in scenarios, to your point from just a minute ago. Just if there's a digital event, you need to know about it, not have 50% of the cash out planned as a fixed value because it's a coin flip. So that, I think, without knowing and having a solid forecast, you can basically just roll your cash daily. Otherwise, you're taking huge liquidity risk that can drive a company into bankruptcy, or default at least.
Yeah. No, super critical. And Quentin, your experience of what's effective, what tools have you found as effective?
Yes, so obviously if you don't have any cash flow forecast, you can't invest at all, I would say, or you
Keeping it just every day, yeah.
Yes, or you may face a liquidity incident. So of course at AGICAP we use our own solution for cash forecasting. And maybe to go deeper, we should separate our two main time scales. We have a long-term one and a short-term one.
Yeah.
Long-term, I would say above 2 or 3 months. So for this, we use, of course, AGICAP, but this is based on the company's business plan that is built by the FP&A team and updated regularly. And this business plan has a cash declination that we can upload on AGICAP through an Excel file every time it is updated. So then with this view, we have an updated view on the business plan and also on the current effective trend. So we can see the gap between business plan and reality.
Yep.
And thus, we can adapt every time we wish to have a new investment or we wish to reassess our current investments. And then, on the short-term horizon, we use a new feature in AGICAP, which is called short-term cash monitoring, that you can see on your screen. So here, you will have a complete vision on each of your bank accounts. You will have your bank balance for the current days, the past, but also the future based on expected transactions. With this view, I spend less than 10 minutes a day to take my investment decisions for the days, for the coming days, and also plan my internal transfers.
Yep.
So how do the expected transactions come from? Mainly several features from AGICAP, like AGICAP Payment, which is our vendor invoice management system. So each invoice will generate an expected transaction at the expected payment date.
Yeah.
And also I would name the debt management feature. We have several lines of banking debt at AGICAP. So this allows us to have visibility on repayment and interest payment. And to finish, we have other expected transactions like salaries, tax charges that we upload in AGICAP based on an Excel file and manual analysis.
Yeah. Okay, so really pulling all those system data together. But your you mentioned sort of your longer term plan based on the the forecast, the budget for the year. In my view, that would probably be more of a medium term, I would say, sort of investment horizon. Longer term to me is probably 6 months to 12 months or even 12 months further. But certainly I feel that that it's that medium term view. But to Eric's point, it's about getting real visibility about what you can do more than the next day. That's the key thing, because you're likely, hopefully, to get a better return for a 1 month, 2 months, or a 3 month investment than you are for just rolling your money overnight. From that perspective. So, that's the real value that comes out of the hard work, but it's actually not as hard as it used to be, for doing that cash flow forecasting. So let's move to the next question. And what are typically the types of investments that you make, that treasurers make for both short-term and longer-term placements of excess cash? So what do you see, Eric, from that?
I think for me personally, and we have from the PwC Treasury Survey, we have a nice analysis there that exactly reflects my personal and probably your personal experience. The most is just fairly simple, plain vanilla, dealing with your counterparty banks in short-term cash deposits with your respective banking club or maybe beyond. So I think that makes up the highest percentage. Why? Because you can have direct credit risk assessment of your counterparties. You can have diversification in there, and it's OTC, so you're flexible. You can do it daily, weekly, 5 days, 10 days, whatever you need. The flexibility and the reduction and limit in the risk you're taking. I think other elements and other investment opportunities for treasurers, as we can see on the chart, the next in line would probably be money market funds. And there, I think the essence is what's the duration of the fund itself, because that's the interest rate risk that you'll be taking, and can you handle that or pick a fund that matches your respective needs. And everything else might be other direct bond investments with high credit quality, government bonds or something, if you look at those. And then some other options. But I think that matches my personal experience that the go-to instrument is the simplest one because it's flexible and you can grasp the risk that it entails. Yeah.
What instruments do you use, Quentin, at AGICAP?
Yeah, so at AGICAP we use short-term instruments. Those ones should be liquid at all time and also free of capital risk, of course. So for this we use like interest-bearing securities, kind of savings account. And we also buy and sell corporate bonds from our banks that are specifically designed for short-term investment. On the more longer term, middle long term, we will use a fixed term deposit account, like 3 months, 6 months. So here we don't take risk on capital either, but we are ready to accept a poorer liquidity level.
Yeah. Absolutely, and I think it's keeping it simple. If I could just sort of add around deposit accounts, we touched on money market funds, and I think corporates are looking more and more to that. But I think the go-to instrument, as you say, is bank deposits. And if you look at bank deposits and what different banks offer, it can be quite granular in the types of products they offer, and in different countries as well. So whether that be call accounts, or instant access savings accounts. These are the types of deposit products that are available. And what's important is to also look at what deposit insurance protection those accounts might be having. If you place money in the money market, you may not get that protection. You won't get that protection. But some of these types of accounts do have deposit insurance protection available up to certain limits. In their country, whether that be call accounts, whether that be notice deposit accounts, or as you mentioned, Quentin, a sort of bank bond type. But you made a very good point for short-term cash investments. So that's not necessarily a typical bond that a bank would issue for medium to long-term debt, for example. That wouldn't be the type of instrument. But you can get bank deposit insured bonds for 1, 2, 3 months as well out there in the market. So let's move on now to the strategies for optimizing returns and very importantly minimizing risks associated with cash with investing excess cash. So Eric, from your perspective, what strategies would you see?
Yeah, I think it all starts with the good old no free lunch argument. Because the question, especially when the interest rates were zero negative, that we got quite a lot also from clients was, is there any way that I can earn more on my money? Unfortunately, the answer is, if you take more risks, you'll have a higher expected return, but you'll also have more risks and more potential for losses. So that's not something that I personally feel is in the interest of a corporate treasurer. But the risks come from different sources. There's credit risk, liquidity, market risk. And I think you have an opportunity, especially when we're talking about advanced cash flow forecasting, better data, more sound forecasts. If you can extend the maturity profile and go out longer, then that's a pickup you can take without necessarily incurring more or a lot more risk. So that would be the one where I would say, okay, that might be okay as long as your foundation, your good cash flow forecast, gives you more leeway here to go out further if you don't need the cash before. Yeah.
And Quentin, what has been some of your strategies around returns and minimizing risk?
Yes, so maybe if indeed there is no free lunch, at the beginning when rates began to high, we had a very poor knowledge of available investment tools. So first we challenged our banks to try to find the best investment instrument in terms of return and also risk management. And we also worked with an investment broker. And this was very, very helpful to get alternative ideas and fresh updates on the market. In terms of risk management, indeed, I see two main of them. First one, the liquidity. As a corporate treasurer, the last thing I want is, for example, to be late for the salaries payment. All the more if I have lots of cash invested. So it's important to set your investment duration based on your expected cash outflows. And then, of course, the capital loss risk. So this is why we always invest at AGCAP in capital secured instruments. And I would also add the fact that we take into consideration the counterparty risk. so our banks. And this is why we never invest more than like 20-25% of our total cash in a single bank.
Yep, diversifying that risk, and we'll go on to how to put parameters around that in a little bit more detail later on. So how should companies balance the need for liquidity with this pursuit of higher returns, in a rising interest rate environment, or we might be coming to the end of a rising interest rate environment at the moment? So you talked, Eric, about maturity profile and getting better predictability, better visibility to what you could invest for. But are there any other considerations for balancing the need for liquidity and getting those higher returns?
And I think, aside from what we already spoke about, I think an important topic that I've seen in many risk policies, which I think is a good thing, is that Treasury is usually forbidden from performing leveraged investments, if you want to call it that. But that might not even be on purpose. So if you don't have great visibility and you invest for too long, then you need to take out a loan to cover your liquidity needs. And basically what you have is a leveraged investment with a bank. So fortunately, many treasurers are very conservative there.
And that's good. And that's good. Absolutely.
Absolutely. And other than that, I think, being flexible, at the same time putting the foundation in place. We talked about it. We'll talk about it more. Everything should be in a sound risk policy environment.
I think one other key point also is around the need for liquidity. You think about investing on a longer term because you're going to get a higher return. But if you have an inverted yield curve, you're actually not getting a higher return. So the need for that liquidity then becomes even more important, because why would you put investments out for a longer period when you're not actually getting a reward for that? So that's something that has to be watched in the market, and we are in a little bit of that type of environment at the moment. It won't stay there all the time, but that is something for people to take into consideration at the moment. It doesn't mean you don't invest, but maybe not for quite so long, because you're not getting rewarded for it in tying up that liquidity. So Quentin, what's your how do you conservatively manage this as well?
Yes, for the past period, let's say the last 18 months, the rates increase period, we invested into a variable rate investment product with quite flexible exit conditions. So this way we could benefit from this rise, very effortless, in fact, and we also preserved our liquidity during this period.
The number one is that liquidity risk and preserving that. Reward is secondary, but it's better than negative that it was in the past, for example. Okay, can we move on to the next then, and saying, can you share some best practices for creating something that we've touched upon really, which is an investment policy for managing excess cash? So I think it's absolutely fundamental that companies put a good investment policy in place, so that the people like Quentin doing the cash placements know that the board and the company knows what they're doing, knows the risks that they're taking. Quentin said, risk-free investments, there's no such thing as a risk-free investment. Things do go wrong, in the market. So, that investment policy and everybody knowing exactly what's being invested in, I think is critical. So, what do you think some of your best practices that you've seen, Eric, in that area?
Yeah, I think you already mentioned it. So fundamentally, an investment policy for a corporate is basically a risk policy. So you need to have every risk aspect covered, every risk category, be credit, interest, foreign exchange, diversification, concentration risks as well. So everything should be in there, and management, not only the treasury people, should have a view on it and understand it, but the guidance should come from top management, with Treasury being the business partner, advising them, okay, this could happen here. What's our risk tolerance here? So if we're talking about credit risk, Is single A the lowest we want to go, or do we feel comfortable with triple B ratings, or maybe a little bit lower? Who knows? But that's something that needs to be in there, stated. There needs to be a nice rule set in place. And guidance we can take, and we've taken, or other clients have taken, depending on the sector, might not even be obligated to follow them, but there are regulatory standards for financial institutions, for asset managers, that are obviously relevant for the topic and that you can also take into account, be it concentration risk that you mentioned. You won't necessarily find that in a regulation for a corporate, but for asset managers you will. Yeah.
No, that's a very good point. It's probably more complex than a company needs, but there's some good aspects in there around diversification, and that financial institutions have to follow. That is best practice for a corporate. To use some of it, I would say. Yeah. In that regard. So Quentin, what is some of your best practice approach to the investment policy?
Few things to add. I can't agree more with you. Indeed, I would insist on the necessity for the corporate treasurer, chief accounting officer, to discuss with really the top management. Even if he only invests in very common classical products, it's important to discuss about the level of risk and liquidity with the management.
Yeah. No, and I'm an advocate that has to be done. Up to a board level. Has to be kind of signed off and make sure everybody understands up to that sort of level, and possibly come back to the board on a fairly regular basis as well. So we've touched a little bit about pulling in various data from various different systems, but and we've touched upon this has always been a very difficult topic for corporate treasurers and finance managers to do good cash flow forecasting. But what role does technology play in assisting companies to gain a better view of their investment capacity? Do you think it's changed a lot recently? What's your view, Eric?
I think that technology, both on the corporate side itself, so what tools in the past, I think the threshold for when a TMS makes sense due to cost-benefit analysis was much higher, probably. Yeah. But with new technologies and new market participants, I think the threshold is fortunately coming down and moving. I love Excel. I know a few finance people who don't, but I think in terms of a system, it's not the choice you want to have due to operational risks. So at some point, technology being available for the corporate and on the banking side, your counterparties, to have access to this data via APIs or other data that are extremely relevant here. Yeah. Your counterparties need to have technology that supports it as well. So I think it comes from both angles. But it's critical and essential to anything where you move to real automation and straight through processing.
Yeah. Yeah, no, I think that's the exciting advances, is that you may still need to have some Excel there, and I think Quentin mentioned that you do still as well a little bit. But I think what's exciting is the ability to tap into real-time data in systems via pretty straightforward APIs was something that 5-10 years ago just wasn't possible. And if you look to doing any interfaces into any systems, you're talking 6, 12, perhaps 18 months in some big companies to be able to even just connect two systems together. I think that's how technology is changing very significantly. Quentin, what's your view on that?
Yes, so I would say that indeed at AGICAP we are very proud to have kind of democratized cash flow anticipations, especially for small and medium companies, thanks to great technologies like banking connectivity. We use several protocols, banking protocols like EBIX, EDITRAN, DSP2, the European Open Banking Law, so that our client can have up-to-date and accurate information about their bank balances. We also have great tools connectivity with things like ERPs, accounting systems, invoice management systems, spend management, so that we could collect information for forecasting operations. Maybe on a more long-term perspective, we have a feature called P&L to cash.
Right.
So for our clients who may have a business plan with a P&L but not necessarily a cash declination, it's a feature that allows them to generate their cash forecasting from the middle long-term perspective from the P&L, and it's great.
Yeah, good. You hit upon a great point around banking connectivity, and open banking is alive and very well in Europe and continuing to grow, is in the UK as well, and banking aggregators are becoming ever increasingly popular in the US as well. There's some very, very significant players that are allowing you to connect your banking data to different systems in a much easier and in an industry standardized way. Which is making it so much easier than it was in the past. So let's move forward and into the dynamic markets that we live. How important is being agile and adaptable to your cash placement strategies? And if you've got a investment policy, how nimble and adaptive does it need to be, or what your actual strategy is, your cash placement strategy? Should you review it and assess it weekly, monthly? What are the advantages of these reviews, and what are the risks potentially of delaying and neglecting to do a regular review of this strategy? What have you seen in companies, Eric?
Yeah, I think I'm a bit torn, to be honest. So on the one hand, I think for any strategy, for any system you put in place, it's essential to have a review cycle for the policy, for the methods in place, be it annually or maybe at a slightly higher frequency, because inside something can change. Corporate goals, the business can change, and you need to check if it still makes sense for where we are now as an overall company. At the same time, the outside can change. Market conditions can have substantial shifts. So you do want to have a review cycle, but I would probably lean more to something more away from weekly and more closely aligned with annual, maybe. Yeah. But at the same time, I think a strategy needs to be flexible and good enough, so I don't have to adjust it just because interest rates shift by 200 basis points. Because if it can't withstand a market shift, then it's probably not that great to begin with. So I think that's sort of the two sides of the coin here.
Yeah, no, I couldn't agree more. Your policy's got to be flexible, to be able to give some judgment to deal with market conditions. And you mentioned about interest rates, varying by 2%, for example. But what about also in a dynamic moving market, like we saw in the US when a number of US banks, got into difficulty? The rating agencies, weren't about to change the ratings. The ratings were what the ratings were. And, you could be sitting there saying, well, the policy says I can invest in them. But, most people got their money out as soon as they could when the market was changing. So I think it's making sure that the policy has that judgment flexibility so that you don't have to wait for the next board meeting or the next, executive meeting to make a change because, you're seeing a dynamic move within the market. So Quentin, what's been your approach to those reviews and reassessing and having flexibility?
Yes, so I would say obviously reassessment is key for the kind of investment manager in terms of internal input, as you said, but also external in order to manage your risk, but also your opportunities that can arise from the macroeconomic context. So if we take the external side at AGICAP, we don't have kind of stock market or fixed market exposure. However, the reference rates interest is one of my top priority when I need to reassess my investment. So for every investment decision, and also at least twice a month, I check the rates level and also the forwards. And recently, I would say the visibility is quite bad on those rates. So everybody wonders what will happen. But we we hear that it may be the peak of the current rates in the European zone, but also maybe in the US.
Yeah.
And in this context, what we'll see is that the best return you can have on investments is on very short-term range, like 1 month.
Yep.
So in this context, 2 decisions were taken recently at Agicap. First, focus more than ever on daily investment optimizations, but also we have invested in very long-term investment products with fixed rates in order to lock the rates in the future in case the reference rates could go down. Indeed.
Yeah. But again, the ability for you to see how much of your excess cash you can lock in for longer term comes to that really good cash flow forecast to give you that confidence, but then flex, leaving then a larger proportion, let's say, to overnight or very short-term investments, to continue to maintain the higher rates, but you're obviously going to be risked potentially when rates start to go down.
Yes, but even with very long-term investments, you can have a pretty good liquidity level, like 1 month.
Yes, you can.
So
yeah,
that's all right.
That's right. But keeping that balance and diversification, is still very, very critical.
I think one point I might add to your point on the banks. So 2 policy changes we did see quite frequently over the last years when the interest rates were low. One was the golden rule: pay late, collect early. Was thrown out the window, but it was in policies all over the place. So you weren't allowed to pay early because your policy said, I can't pay as soon as I can to get rid of the cash. So that's a policy.
When we had negative rates,
when we had negative interest rates.
Yeah.
So we did see policy changes there where companies rewrote the relevant passages because it was the economically feasible thing to do. Yeah. And the second one, exactly post Lehman, when all bank ratings actually did come down, you had trouble putting your money with banks because it used to say AA, single A, but at a certain point of time there weren't that many single A or AA banks around, so you had to also change that. Otherwise, you would have huge concentration risk.
Yeah, no, there's a great examples. So let's go on a little bit more now and to drill down into key performance indicators or KPIs. How can companies establish KPIs to measure the success and efficiency from their cash placement strategies? What have you seen, Eric?
Yeah, I think one measure is naturally, as we've talked about it, the cash visibility and maybe cash mobility. You can put a KPI around that. For what percentage of my bank accounts, my cash placement, do I have daily, hourly visibility due to data connectivity, or maybe just what the accounts are? So I think that's a good one, and the natural target would be as high as possible.
Yep.
I think the other one that comes to mind, but that needs to be evaluated very carefully, is any performance. So do I want a target in terms, obviously, with risk being low, you said it, risk being low is more important than higher returns for a corporate, as it should be. At the same time, if you put KPIs in place on some sort of return figure, that can be a pretty dangerous thing. But if you have a sound risk policy, you could attempt it. But I think it needs to be done very diligently, to be honest, if it's done.
No, I've said as long as you even get above 0%, then that's what you should put it in, so people don't take that extra risk of trying to beat a return in the policy. You've got to have that flexibility, and rates are going to change all of the time. So what do you do? How do you report KPIs inside Agicap?
So very simple on our side. I report 2 KPIs to my management each month. The first, which comes from the accounting, is the ratio between interest generated during the month and the average level of cash of the company.
Yep.
The second one, I get it through Agicap, is the average level of cash, average daily level of cash not invested during the month. Typically at Agicap, I try to keep it below 1 million euro.
Great. Yeah, that's a good and good measure to report out on. I couldn't agree more. So final question before we go to the audience questions, and I see we have some coming in, which is great. How do you envisage the future of excess cash placement and management as technology continues to evolve and economic conditions change? So, Eric, what is your view on that?
Yeah, I think so. In line with my initial argument of cost of carry as being sort of the prime figure here or target, I think as technology and other aspects continue to evolve and Treasury has more time to do actually value-adding thinking and generate value for a company, moving more and more towards sophisticated and holistic asset liability management. So where you don't just look at the investment side, but you look at your balance sheet on the funding side as well, and not only align with the operation. So how am I funded? Does that match my real assets? But also with the investment cash that I don't need right now. And not only for one currency, but we're usually talking about many currencies. Yeah. And if you look at FX, also hedging, you have interest rate differentials, not only interest rates in one currency. So looking at a more full picture, I think, once you have the actual time, because your standard view
much more
is
strategic. Yeah. Couldn't agree more. And I think getting that natural hedge and match where you can as much as possible to net off your exposures from your assets and liabilities, I think is a real key thing. And particularly with the volatile markets that we are in. I certainly feel that excess cash placement with technology will become incredibly automated in the next 5 years. So the rules that you put in place in your investment policy will be simply configured. I won't use the word coded. I'll use simply configured in your systems, and it will happen automatically. Yeah, and I think we're not that far away from that. And I think why is that important? I think the last 18 months have demonstrated to us that economic conditions can change very quickly. We've seen interest rates rise much quicker than we have ever seen in the last 2 decades, let's say. That means we need these things to be automated, and we need these things to be kind of working on autopilot, with all the controls, etc., put in place. But I think, that's the exciting area that I think is possible. And then to your point, it means treasurers and finance directors can do more strategic things and look at that asset liability matching. What is your thoughts on the future of technology in this area?
I would totally agree with your point. I would maybe add that at AGICAP, we are indeed working on this kind of technology to give our clients always an easiest way to choose their investment opportunities. And so we are currently developing great features that will allow to, for example, give you suggestions about investment opportunities.
Yep. Okay. So I think I've got about three key questions here that so me ask the audience first of all. So this, I think, Quentin, I'm going to come to you first because it's specifically talking about AGICAP. So how AGICAP can manage our cash flow if it's up to us to categorize all of our operations. So I think it's Morgan, how can AGICAP help them manage their cash flow if it's up to the company using the AGICAP to have to categorize your different operations? Maybe your thoughts on that.
Well, in AGICAP you have a kind of pre-categorization mechanism that you can improve by creating rules for some recurring flows that don't categorize automatically.
Yep.
And when everything is set up within a few weeks, let's say, I would say 90-95% of your operations will be pre-categorized, and it will be fine.
Okay, good. So and that's also just as much getting the feeds from the different systems in as well.
Yes.
But then once it's into AGICAP, you can then categorize it.
Yes, you train it, you create rules all along the time, and then it should be pretty automatic.
Yeah, I see one of the key things is making sure that you've got all of those feeds from all the different systems, in place for you and to be able to use the categorization tool that's available. So next question from same person actually is why, so this is built on this, why is categorization automatic, but if it's up to us to do it after entering the information? I want to also understand how risk management works on AGICAP. Is the training provided to explain this, or is it our responsibility to stay informed on these aspects continuously?
Okay,
Over to you again, Quentin.
Maybe on the first question, I think the answer is the same. At the beginning, our users have to invest a bit of time to create rules for this automation to work effectively.
Yeah.
And then in terms of risk management, we at AGICAP, we ease the investing process, but we never give any investment advice to our clients, and our teams are aware of this. So there is this kind of risk management policy, yes.
Yeah. No, and my advice, to you would be is to, get that independent advice, whether that be tax, accounting advice, risk management advice, from a professional firm that specializes in that particular area. It is a common aspect that most companies will do, particularly when they're putting in place an investment policy, to understanding that. It's kind of like part of your due diligence. So having the power of the platform that you have, but then putting the rest of it into place will mean you'll have to talk to other professional advisors, other experts in this area, to give you what I would say a sustainable policy and a sustainable strategy, for investing cash on a long-term basis with, as minimal risk as possible.
Absolutely.
Which is the key thing. And I have 2 or 3 more questions come in, so we have a little bit more time, which is good. I'd like to know if you suggest your clients have an LEI code, legal entity identifier code. That's an interesting question. What's your thoughts on that, Quentin? Or
I think it's a code that allows us some investments. I think here also this discussion should be with your bank or your investment advisor, investment broker. This would be the best answer. Yeah.
I mean, you're probably experiencing this as well, Eric, but there are standard industry legal entity codes, and that can be useful to be able to be used, within your systems, but it's not perfect, I would say. At this point, would you like to say anything more?
Yeah, I think it's a good question. I think the official answer has to be, if you're required to by any regulatory standard to have an LEI, you need to get it.
You need to get it, correct.
And for certain instruments, you will absolutely need it, due to regulations like EMIR and stuff like that.
Right.
And
That's true.
To be honest, in the past when LEIs came up, I was still on the corporate side, and I found it extremely interesting because what it would have the potential to be is this globally standardized.
Potential. You've said the word potential.
Globally standardized, what's in German a Firmenbuchnummer, a company registry number, which are totally unstandardized country by country. So that it would have the potential to be that. So that might be a compelling thought, but I don't think it gained this. Everyone gets one, so you could set up data. Once again, we run back to data. If you have an LEI for every company, you have a much easier time mapping data through all systems in a standardized way.
Yeah, no, I couldn't agree more, because the legal entity in one system may have been set up slightly differently to another. I couldn't agree more, and it's just not happened. I think improvements are being made, but it's still a long way from where it needs to be, and it's still very country by country, as you mentioned from that. So next question is: can AGICAP conduct a cash pooling over several legal entities? I think the answer to that is no, but Quentin, do you want to?
Yes, if you mean a cash pooling, like 100% of your cash is centralized each night on one account, no, we don't have this as an automatization. But we are working on some features that could allow this or ease this. Maybe what I can tell is that today at AGICAP we have about 13 operating accounts with hundreds of transactions every day. With the short-term management page that we saw before, in my 10 minutes daily routine about investments, I also can manage with this view every internal transfer that needs to be done.
That's it.
In order to face my coming operations in the next days.
Yeah.
So could be some kind of indeed cash pooling or optimization.
Yeah, I think you have to look at, can cash pooling be done by your bank? That's probably the main
Yes.
area. But it sounds like the reporting of the different legal entities can be done, and you have the ability to move cash potentially between legal entities.
Indeed.
If it's allowed by regulation. Some countries don't allow it, as Eric and I know very well.
And after taking the cost into consideration, of course.
You take the cost into consideration, your foreign exchange costs potentially as well, if it's not in the same currency.
Yes.
But some countries don't allow you to move money, between legal entities, cross-border, for example, but some do. So whenever you are looking to, not say cash pool, commingle funds between legal entities, yes, you can transfer between legal entities, but before you do that, it's absolutely critical that you make sure you understand what the accounting treatment is, what the tax implications are, because you could be caught out very easily if you're not careful. So it might regulatory be allowed, but you would have adverse tax and accounting consequences as a result of it. Anything you want to add to that?
No, I think absolutely. We had an interesting topic, and I can't obviously name any specifics in that area with emerging market currency, and that was exactly a classic trapped cash situation.
Right.
In an intercompany structure, so I think you need to be very careful. I think what can technology again and innovation here towards instant payments, if you have all your ducks in a row on the tax, accounting, regulatory side, a tool can facilitate, if bank fees are low, can do something like cash pooling, but on a tool. There are obviously transfer proposals and automated intercompany transfers in various tools already. But if you have this instant capability, you can just do it right before cutoff.
Yeah, absolutely.
Route everything through
you can do
and
it.
replicate.
As long as you can move the cash between those legal entities. That's critical. There's one for you now, Eric.
Oh.
There's a great question for you here. Investing free cash in the stock market is, of course, very risky. Good. I think we agree with that. But does either AGICAP or PwC have experience with this kind of investment? Okay, Eric first.
We have, not PwC, but in terms of we've come across very good and sophisticated clients in their investment activities who in the specific situation had a very long horizon for potential investments. And in that case, I think that's something we haven't touched upon earlier. What do you have? You have additional risk. So stock market volatility.
Massively.
I'm no expert on the stock market. I'm a very plain vanilla guy in my personal life. But a huge volatility in the short term, which over time evens out to some degree. So if you have the opportunity and you're very well diversified, in theory, you could consider it, but not for a short period. So I would absolutely not be for that. And even those clients that I mentioned, they have a nicely diversified portfolio and they have experts doing it. Yeah. So it's not something to be taken lightly because it's your company's fund.
Yeah.
And you should probably, instead of, then you go back to what was it, Modigliani Miller at the university.
Yes, that's true.
You might not, your investors might not want you to go stock picking, to be honest.
Yeah. I think a situation where that, maybe if it's part of not necessarily the Treasury's specific operation, but if it's part of the strategy of the company to build a stake in potentially an M&A target and start to build a very small stake, that might be something that a company does. But I agree, I have seen companies doing it in emerging markets in my time in Asia, for example, that people do. Companies will invest in other stocks in the market. It's not necessarily something that the treasurer is behind, but it might be the founder of the company or somebody who's willing to take that extra risk, which is not something that we advocate at all, is it? And I'm sure from that perspective, I assume AGICAP doesn't do any of those types of investments. There you go. That was easy.
No. And I would say that my personal experience with the stock market as an investor would not push me to invest
push you to do it as well. Yeah, no, I'm with you. Similar. So we have 1 minute over, but I think if we can, we can just ask this final question. In the United States, we assist companies in developing or revising their cash and treasury management policies, which complement their investment policies. While investment policies often are in short-term instruments, cash and treasury management policies, a broader spectrum of key performance indicators. In the UK and Europe, do you separate these policies into distinct frameworks or integrate them into a comprehensive approach? Probably a question for you, Eric, if you... United States...
I hope I got the gist of it.
Yeah.
So basically, I think when you talk about policy in general, and that's not just my personal opinion, I think you need to have a policy hierarchy. Just like you have a strategy hierarchy, the overall corporate strategy needs to align with every strategy that's derived from it for departments, for different business activities, similar to guidelines and rule sets, I think. So it needs to be top-down, and they need to be in sync and in harmony, naturally. And what we usually find for Treasury, you have an overall guidance that's more general, and then depending on your specific topics, individual guidelines, be it risk in general, or maybe FX is a huge topic. You have a separate FX risk policy and other risks in something else. But it needs to be aligned and as detailed as you need it for your business, and to some degree, at least a certain threshold to have a valid policy that we mentioned earlier.
No, I think that's it. You have your investment policy at the board level, at the first level, and then as Treasury is then governed by the investment policy, able to go into different instruments in foreign exchange, in investments, in the way that they're borrowing, etc. Then you would have additional policies that go into a more granular level at that next level into those various aspects. And if you're a smaller company, you probably may not need them, but as you grow, you probably then need to to build them out further as individual. As you say, foreign exchange risk management policy, investment risk management policy, etc. Going forward. So yeah, great question actually. To be honest, and I don't think it's massively different here in Europe as it is in the US. But it also is as much as to where you are in the size of the company and the stage of sophistication that you might be in. Yeah,
exactly.
Well, we're absolutely up to time, and I want to thank the audience for terrific questions, and I want to particularly thank my panelists, Eric and Quentin, for what has been an absolutely fantastic discussion, and hope everybody has enjoyed it.
Thank you for having me.
Thank you, Simon.
Thank you, and goodbye to everyone.
Bye.